Roongta. Thank you for joining us today on The Money Show. Were you too perturbed by this 0.005% stamp duty?
So I think the percentage is clearly not perturbing, and I'm talking from the point of view of a retail investor. I mean, retail investors don't put money overnight or even for 4 or 5 days. Even when they invest in liquid funds, their holding would be 15 days, 30 days at least. Even over 30 days, the impact is like 0.06%. Significant, not very high. One day impact, overnight fund which corporates keep, I doubt any individual ever does that. That's like 1.83%. That's very significant. Uh, but over long term investments, this is a rounding off number. It probably won't even classify as a rounding off number. So the percentage itself does not perturb you. I think the very act that there is now a stamp duty, it creates some friction in the transactions, and the fear lurking behind is that given the state of government finances, there is always need for raising external more and more money, and therefore this 0.005 will probably become much higher in the future. I mean, we have many examples. Think of the dividend distribution tax that started at 10%, and at its peak it was some 21 odd percent. So I mean, these kind of things have a habit of growing, and I think that is what the perturbing trend is, and the fact that it creates a little bit of friction in transactions. Transaction tax on financial transactions is not a very welcome sign. So whilst the amount is not a problem, I think the fact that it is a transaction tax is a little perturbing.
You've raised a very valid point, I mean, yeah, if you read the headline 0.005%, okay, maybe we can, take that hit, especially because, we are long-term investors. So it's an extremely minute hit as such. You can't even call it a hit. But the fact that it's been introduced, the fact that there is a tax or duty rather, when I am conducting a transaction, when I am doing a SIP or buying a mutual fund, and that concept itself should be a bit worrying more than the amount, because now that it's been introduced, it gives the government some room to sort of play around with that number. So today it's 0.005%. Tomorrow, if the government feels that, it needs to garner funds, and it always does, right? I mean, every year we do see the fiscal deficit number constantly expanding, or the government not being able to meet that, and hence avenues like these are a great way to sort of generate some revenue from the public and from the citizens, and that's, I think, the more niggling point. So I guess, yeah, I take your point that from that point of view, maybe it should worry a few investors. So, Mr. Roongta, let's talk, since you mentioned that, for retail investors who invest in the long term, it's not going to be much of an impact. But let's talk then short term. Many a times, and, we as well on the Money Show have often said that, if you've got some money lying around, but you feel that you need the money in the fairly short term, we advise that you put it in a debt fund or a liquid fund where, there will be liquidity, means you can withdraw it soon, and you can park the money just for a couple of days or a couple of weeks, as opposed to a savings account where you have that you just have 3 to 4 odd% of interest, and now perhaps it may be lower. Do you see a larger impact over there, or do you see a reason why such people should fret over this hit that they may take?
Oh, absolutely. I think if you have money only for 5 7 days, and remember, you are retail, you're not really a corporate which has a treasury and who can do daily transfers and things like that. I think the sheer hassle of putting money into a liquid fund, withdrawing it after 5 days itself is an hassle. Now, with the additional tax, I think it will make even more sense. Couple this with the fact that there are certain banks, okay, which are offering 6%. I think IDFC First Bank is offering 7% interest on savings bank account. I mean, that is the best liquid fund that you can ever hope to have. I mean, it's a savings bank account in a proper bank. So, what else would you need?
Okay. All right, so that's just essentially on liquid funds, and largely from what we understand, the impact would be, more maybe for a corporate or somebody like that who, they usually in their treasury operations put their money in liquid funds overnight or just for a couple of days. Mr. Roongta, this stamp duty is not just for mutual funds, it's also for shares. So every time I purchase a share as well, I'll have to pay 0.005%. Now, I'm sure you as well are aware of this trend that has occurred. Every broking company tells us that they have seen an increase in the number of demat accounts. As people are sitting at home in this lockdown, they've started indulging in some trading. It means they're watching more ET now, that's great, but the fear is really that they are they may not be having the experience, but since things look so tempting in the market, they've decided to dabble in a couple of shares or so. Since we are on this topic, I would like to take in your opinion on that and how maybe stamp duty could deter this activity.
Well, I think as you yourself mentioned, when this is the way that you're going to pass your time, okay, a 0.005% duty is hardly going to deter you. I think it is if you're doing day trading, I think, and fortunately, I don't know the numbers. I think data only the broking houses can share. But I think doing day trading when it is not something that you do for a living is an extremely dangerous trend, especially if you are participating in the forwards and options market. That is not something that non-professionals should be doing. And it is a fairly risky trend. And I suspect, but with the risk containment measures that have been put in place, the amount that they can play around with would be limited, and therefore, although currently I think a lot of them have made a lot of money over the last 2 months since the lows in March. Over the last 3 months, we have seen a huge resurgence in prices. So I think a lot of them who are first time beginners may have made a lot of money, and therefore, they have tasted blood. Uh, I'm sure the risk containment measures will ensure that they don't go overboard, and probably they. I mean, one just hopes that uh, any lessons that they learn are not so huge that they go away from the equity markets altogether. If they go away from the day trading on stock markets, retail investor, that's fine. They should not go away from the equity markets altogether.
Yeah, well, definitely don't shun equity markets altogether. But yeah, it's something that we as well have not advised for those individuals who don't have experience in the equity markets. Day trading is something that could be quite hazardous to your financials. And yes, your view on this entire stamp duty imposition on shares, Mr. Roongta?
Again, as I said, so shares should be bought for the long term. And when I say long term, I mean 8 or 10 years. If you're talking 8 or 10 years, what is this stamp duty? This is nothing except an irritant. But with stamps, people are accustomed to irritants. There are transaction charges, etc., that is there in the broker's contract note. So this stamp duty for a share transaction will just get dismissed as one more of the charge. So I think for shares, it will have a much less impact than mutual funds, where the investors are not accustomed to seeing charges on purchase. On sale, they are accustomed to seeing the securities transaction tax, at least for equity. But on purchase, they are not accustomed to seeing it.
Yeah, good point. Okay, all right. Well, that's of course all about stamp duty on mutual funds and shares. Just a couple of lessons. Obviously, the bigger the amount that you're investing, the stamp duty as well will be higher. It will be auto deducted. So that means the next SIP that's cut from your bank account, let's say it's 10,000 rupees, the entire 10,000 will not be utilized to purchase MF units. A small portion, a very small portion of that will be put towards buying, put towards paying off stamp duty, and then the balance will be used to purchase mutual fund units. And again, if you are a long-term investor, the impact is negligible. If you are a short-term investor, you may still feel maybe a pinch, but over there as well, it's really in points. It's not something that's really big. So it's extremely important to understand that. And yeah, between a savings account or a liquid fund, savings account returns are extremely miserly right now. FD returns as well. In fact, you consider let's say a 7-day bank FD as well is extremely small. It's at least smaller than what a liquid fund can give, even after deducting for that stamp duty. So at this point of time, you don't need to worry too much about the stamp duty that has been imposed. Okay, well, time for viewer questions and queries. Then we've got so many lined up, so let's see how much we can squeeze in with our limited time with Mr. Roongta. First up, a very interesting question coming in from Santu Mondal. How do I retire rich? Mr. Roongta, I'm sure you've got this question several times from your clients, so I'm sure you have a ready answer for all these questions that come in. But yes, he goes on to ask, how do I keep my retirement plan simple when he already has kids education, he has a home down payments as well, and then of course there's this entire process of constantly updating your portfolio going forward. I think what he's trying to say is basically we have this tendency when we say you have to be a long-term investor in mutual funds, we pick 5 funds and then we just keep investing in them for eternity, for the next decade or so, without even so much so as giving them a glance. So I think he's talking about updating your mutual fund portfolio. It's extremely important to do that. Mr. Roongta, how would you start off by answering his query?
Well, the best way to retire rich is invest one hell of a lot, okay? Or live currently poorly so that you can retire rich. Well, that is a very facile answer. I think basically what happens for most people who don't plan is that anyways, every person has multiple goals. It's never only retirement, right? He would have children's education, children's marriage, buying a house, buying a car, furnishing a house, etc., etc. Now, if you have not planned, what happens is that the goals that come first gets fulfilled. The trade-off is that the goals that come later may be more important. Buying a car happens now, it gets fulfilled. But your retirement goal is the trade-off, which if you are making that trade-off consciously, it is fine. Most people don't make that trade-off consciously. I think that is what the planning process imposes, a discipline on you, that you need to consider all your goals, need to allocate resources to those goals, and if resources are short, you need to do a trade-off. These goals I'm going to downsize, these goals I'm going to drop in favor of this goal which is more important. I think this is something, this is what the planning exercise basically is, and it should be done by every individual. It's like when you're doing a journey, you plan the entire journey. You don't plan only the first stop in the journey. So I think doing that is extremely important. Once you have done that, then comes your asset allocation, that you allocate appropriately depending on when the goal is, what your risk profile is, how much resources you have. If you do this and then you give appropriate importance to retirement, you definitely can retire rich to the extent that your resources will allow. But I think whether you retire rich or not, you will definitely retire satisfied that you did your best. And I think that is extremely important.
Okay, all right. Santu, I hope this helps you with your wealth creation journey. You need to, of course, if you want to retire rich, it requires planning way in advance. And you're young. I think you had mentioned somewhere that you're 32 years old, so you have time on your side. And yes, that's essentially Mr. Roongta here to guide you with that and start you off. All right, next up, we have a query coming in from Raghavendra P. He says, please suggest me funds to add in a portfolio in 20 years for retirement and also contingency fund. Very important aspect, an emergency fund. And I think people have realized the importance of this emergency fund during this lockdown in the last 2 to 3 months for people who faced a loss in income because of business disruption or, job losses. So his portfolio is, well, he just has 3 funds right now, very small portfolio of only 8,000 rupees per month, but he's been investing for the last 10 odd years. It's ICICI Blue Chip, SBI Focused Equity, and ICICI Prudential Equity and Debt. And then he also has a recurring deposit in post office for 3,000 rupees per month. That's till 2024, so the next 4 years. A very, very crisp and concise portfolio, but he's a long-term investor, that's for sure. Already 10 years done. Mr. Roongta, what would you recommend?
So I think, first, what will this get him? Whatever he has said, if he continues it for the periods that he has mentioned in his query, roughly the corpus will amount to about 64 lakhs at the time when he reaches 60 years. And that should typically give him a pension of inflation adjusted 6,000 rupees today's value till his age of 85. Now, whether that is sufficient, not sufficient is something that he needs to decide. If it is not sufficient, then he would definitely need to continue those investments for far longer than what he has already stated. Or put in more money. I think one of the two things he would have to do. Do it as per a plan. I sound like a stuck record, but I think do it as per a plan is the first and big advice. As far as the funds are concerned, he has this nice balance, right? He's got a large cap fund, he's got a focused equity fund, and a hybrid fund. I think all the three funds are good. Just for choice, nowadays for large cap, I prefer index funds. I think they're really value for money. You can put it in a Nifty or a Nifty Next fund, put it with ICICI, they have both, and you can put it in that. The contingency fund, the most important question, I think his tax rates are not very high. He mentions a monthly salary of 32,000, which means he's not paying any taxes. For him, I think a bank fixed deposit, okay, is good enough because he's unlikely to be able to get better returns from a liquid fund with the kind of liquidity that a bank fixed deposit offers. So for him, I think a bank fixed deposit is ideal vehicle for his contingency in the same bank in which he has an account, so that if he has to break it, he can break it online.
All right. Okay, there you have it. That's the recommendation coming in. Raghavendra, I hope you've taken note of all the chops and changes recommended by Mr. Roongta. But that's all the time we have. We'll not be able to take any more questions. If we've not been able to take your query, don't fret. We have many more episodes of The Money Show lined up. So continue staying tuned. Mr. Roongta, of course, as always, a pleasure having you with us. Thank you so much for joining us today and patiently answering all our questions and queries.